Good morning and welcome to the Macro Show for Wednesday, March 13th. I'm Ryan Ricci of the Macro team, and I'm joined by Hedgeye CEO Keith McCullough. Keith, we got a lot of new listeners today. A little free episode.
Did you put a stash on for this one? Did you shave that into a stash? Can I see that or no?
I did
I
not
like
shave
that.
it. I've been actually deep in under some rocks and forgot to shave.
Well, you've been underneath the quant and the machine.
Pretty much.
For those of you that don't know, his nickname is the Rooster, Ryan Ritchie, and he does not care about your narratives. All he cares about the numbers embedded in the machine, which we highly suggest you should consider. Thank you very much for joining us. We appreciate it. After we get something really right, and that's generally when the crowd gets it really wrong, and it doesn't mean that we miss the up moves. Don't forget we were long Bitcoin, crypto, like going back to January, Qs, plenty of things. We just don't want our families to incur drawdowns or crashes of our hard-earned capital because that's what we work for, right? We're not here for narratives. We're here for measuring and mapping the numbers. So let's just get into it in the top three things this morning. We do it every morning. We focus on the three in particular things that matter the most, as Benoit Mandelbrot taught me a long time ago. It's the particular that matters, not the average of things, the valuation of things, the price targets of things, all that old wall baggage. Free yourself from the shackles this morning. Do it for you. Do it for your family. Get out of there and start focusing on how to do this job the right way. We'll focus on interest rates. Rates have changed there. Gold in particular, and the volatility setup for the S&P 500 in particular as well. First on bond yields, you get a little bit of a lift on the news. You get some people asking us, even in our own community of people that pay for the process, but they haven't been with me for multiple quad fours. We can go back to Q4 of 2018. You can go back to 2020. You can go back to 2022. We're the only firm that's gone from long to short in all of those environments, by the way, and that's something we're quite proud of. But again, what you typically do after the news is printed, in the case of yesterday, the CPI, and intraday volatility on the S&P, by the way, was like in the 96th percentile on a 10-year look back, Rooster, which is plenty of volatility. That's because what was the CPI days, or the NVIDIA earnings report days for that matter, are what we call macro tourist days. Okay, so it's where the crowd learns something that the Hedgeye Nation has known in the case of interest rates for like 6 to 8 weeks. Now, we've been telling you that the CPI was going to surprise to the downside, this number that was going to be reported in March for at least 6 weeks, probably more than that. So again, markets price that in. Obviously, the 10-year yields come down all the way from 479 at the peak of what we call quad two. Now it's in quad four, having a bounce. So what you want to do with the bounce, very specifically in rank order, is to buy duration via the Tizzle. The TLT, yeah, the Tizzle. You like that. Come on. You like that little Tizzle in the portfolio. When we were short the Tizzle, by the way, from October to January. So I go both ways. We generally do as a team too, and I really like that. So you got that. Investment grade bonds would be another big one. LQD, and I also added TUA, not as in Tagovailoa, TUA, the ticker, to the portfolio for the fam yesterday. For those of you that don't see it, you can see every single position ranked by position size in my family's long only account. Nobody else is showing you that. And I'm proud of how well that's done. We haven't had barely a correction, my family, never mind a drawdown. So that's good because we own things like gold that other people don't own. So that's point number two this morning. If you look at the risk range signal, if you're gonna subscribe to one thing in addition to the macro show, I'd go with I'd go with a lot of things, right? Because you need everything to build a house, as John McCullough taught me a very long time ago. He's like, well, if you want to skimp here and not have all the tools in the toolbox, then you're going to be woefully unprepared when some risk happens. And that's I learned that at a very young age. So when you look at the risk ranges as a major tool in our toolbox, that's a major thing that you should be subscribed to. The risk range tells you a couple things. One, it's a signaling on gold and we're long both paper and which is GLD and physical gold. I told people to buy Liberty coins through McIlvaney Gold, by the way. If you're not buying through McIlvaney, you're not buying it through who I think is, and it's not a commercial, it's just who I buy it from. In fact, I think the mail actually came yesterday, the day before. I'm in the Bahamas, but Laura got the physical gold in the mail. She likes getting gold instead of bags of junk silver, which I've been buying lower because Junk silver is much heavier than Liberty coins, so you can get like a significant sum of gold coins in your hand and not like feel like you're going to go into back spasms. But so anyway, the gold risk range, you should notice it says bullish trend. So that's you want to be long bullish trends and short bearish trends. Okay, that's a real simple, 101 base pack Hedgeye Nation setup. And then when you see the risk range and it's signaling higher lows at 28.61 and higher highs at 29.74 for gold, and that higher high is a half, higher all-time high, half, hashtag half. That's better than like hodl, right? Half. Write that down, right? So gold, I rest my case, is still signaling it's going to make new all-time highs. It has the lowest volatility of any major asset class. It's a currency in our books that you could buy. So it's not like Bitcoin, which has like 55 vol this morning. Do you know what 55 vol is? And how many friends do you have? Those of you that are here that are here for free that absolutely hate me because of this Bitcoin risk management exercise. I mean, how many of you even know where Bitcoin volatility is? But you know everything about Bitcoin? I mean, that's like knowing everything about the world, but not knowing about gravity. I mean, volatility, really? Come on. Get better, get better. You're going to get better. You already got better, and we're only 6 minutes into this. I love that. All right, finally on the VIX, and yeah, Bitcoin's still a short, and yeah, we were long and higher. But again, Bitcoin down 1.5% today. Nobody should be surprised. And yes, I'm short the Maestro MSTR of storytelling and also the MSTY, the Misty MSTY. VIX. Okay, there's no change to the setup here. Now, I review this in the early look. I had plenty of feedback from power users of the process. Anytime I break down specific components of the go anywhere process, again, we're looking at everything always because that's the way AI, the machine, and the universe looks at it, right? They don't ignore like 6 raindrops over there because they want to have this valuation over here. No. Just think about real world things instead of the bullshit that you've learned from Wall Street, who's trying to sell you one thing, stocks, or in the case of CNBC, advertising, right? Now, the VIX is still bullish trend. I go through this. It's signaling top end of the range could easily be right inside of the F bucket. 28.98 is the top end of the range for the VIX. So what are you going to do at 28.98 VIX? I mean, 28.98 VIX, the S&P is likely going to be slicing through 5,500. The round number, it is rare that the low end of my range is an actual round number like these old wall price targets. But today, the low end of the range is 5,500, down 1.8% versus yesterday's close. So if the S&P closes there or lower, nobody should be surprised. That's the probable outcome. So again, you got that. You can see things like 1 month volatility, which is a key indicator for us versus 3 month, because that's what drives systematic selling. When that blue line shoots above the red line, and that's for the 7th day in a row. So you got systematic CTAs are just puking, and that's what drives. Tier 1 alpha would argue 50% of the day's trading. Never mind what your narratives are about whatever stocks or crypto bag holding exercise you're engaged with. And please don't turn this off right now. Those are your top 3 things. All right? If you can't handle any criticism, you're just going to be shitty at what you do, right? You know that, huh? A lot of people aren't coachable. You know that? I mean, I've coached a lot of kids who aren't because their parents aren't, and then eventually the kid figures it out. So as long as the parents don't get in the way, the kid still has a fighting chance. So for those of you that can't take criticism, this is definitely not for you. Okay, so you should hang up right now. And I'd encourage that if you're here for free. Now, if you are coachable and you want to get better every single day and you want to learn from mistakes, in fact, you actually quite lick your chops when you get a mistake to learn from. Now we're talking Hedgeye Nation material. Now we're talking about people that can play at the highest level. Now we're talking about people that can outwork people consistently and deliberately. Okay, so that's what we're going to do for the rest of my prepared remarks. And no, I don't have a teleprompter. What do we got? So what I tend to do I'm in the Bahamas today, so I can't write on the magic board, but I'd write the number 5,500, which is the low end of the range for the S&P down. I'd write 58.87, which is a big lower high. Hashtag BLH. That is not half. A BLH within a bearish trend is as bearish a thing as you could have. So again, that's what the S&P 500 has in addition to the NASDAQ, a BLH, big lower high at 18,799. We got people out of that like a boss. And thank you for the kind compliments from Hedgeye Nation on that front. We appreciate it. Yesterday's update was an update, but it comes with plenty of asterisks. I mean, if you look underneath the hood, the volume was down on an update. Again, when we measure and map things, we don't look at simple moving averages. That's for simple people. And simple people who stay with simple ways end up getting an education at some point, and it's in their account. Now, we don't use simple fact, one factor moving monkeys, price momentum. That's what that is. 50 day, 200 day, whatever day. Today is the day to use price, volume, volatility within fractal dimensions and the rates of change embedded therein. Okay. Now, that might be a lot, but it's okay. If you love AI, it gets even more complicated mathematically than that. But again, what I'd say is the rate of change of volume was down. That's why there's a red arrow that's downward sloping. So down volume on an up day registers in our process on our signal to the machine as bearish, even though the market was up. 6 out of 11 sectors were actually down on the day. The one that was up the most is the one, one of the worst places to have had your money for the last month and a half, which is tech XLK, and that was largely because of Nvidia's counter trend bounce. And yes, Nvidia remains bearish trend. Yes, every single Mag 7 stock, that's what we call them, the Bag 7. So if you're bag holding and you don't like that, you don't like me saying that, then get off the call, go wave at boats or something, all right? Go call your old wall broker and whine about me. That's not going to change what's happening in your Bag 7 account, okay? So again, that's that you can get on with your day. But for us, we have been out of the way on that, and that's been great. The other big thing was that, like, if you look at the impact table, which we show every day through Tier 1 Alpha, even though the market was up 0.5%, and that was, again, you can see 22% of that was Nvidia, 9% Tesla, and Meta was +3. So a third of the move was in 3 stocks. Meanwhile, 64% of stocks were actually down on the day. 2/3 of stocks were actually down in the S&P 500, and for the Russell, it was worse than that. Down an average 1.5% of the day. Cross asset class vol. Have you ever heard about that? Never. I think people call themselves enthusiasts that are along certain, like, yeah, you're really enthusiastic about not getting out of Solana before it went down 37% in the last month, which is currently down. I'm not enthusiastic about that. There's no enthusiasm there. Now, I get that you're enthusiastic about gambling with no cost trading commissions, but that's different than being enthusiastic about having an ability to preserve and protect your hard-earned capital over time. Okay, so what we are enthusiastic about is the process. Now, if you look at cross asset class volatility, which you should always look at before you make any decisions out there, that's like looking at the weather. Do you look at the weather in the morning, or you just ignore it because you want to enthusiastically think that it's going to be sunny with rainbows and puppy dogs out there? I don't know what you need to believe, but I'm telling you what I believe, and that's to look at that. Move index came down but remains bullish bullish breakout move. That means when the move moves up, that means that it's a good time to start thinking about adding duration to your portfolio, in this case, TLT or the Tizzle, which I already mentioned. You can also see in high yield, it's up at 313 on high yield spreads. I'm getting a lot of questions about that, if only because I've been writing about it for a week, but also, highlighted it in the top 3 things yesterday. Now you're seeing the old wall actually notice. If you look at, actually, guys, pull up the chart on 10-year triple Bs. So yeah, it's widened. So here's a real good lesson. In quad 4, you see how it did it in July, it went up. And again, here in quad 4, it went up again, but it keeps going up to lower highs. Well, that means that it's lower high, credit risk is developing, but it's not breaking out like it would if we had a recession. The other thing you'd see in a recession developing on our signal, again, don't just look at one thing. Don't do that. Don't. 50-day moving monkey with the candle. Oh, those are 2 things you're looking at. Oh, great. That's just great. Well, we look at everything. Okay. So again, and we're the only firm to call all stock market crashes since 2008 and recessions too. So, I mean, there's no recession in our numbers. There's just quad 4, which is a rate of change slowdown. Now, if you were to see, if you look, actually, 10-year triple B is the chart, but back to that high yield chart, you'd have to be above 336 basis points over on high yield OAS. Please write that down. What else? Just to hit on the Tier 1 Alpha data, the rest of it, short-term calendar vol came way down yesterday. That's partly why the market rallied, is that the hedge pot was boiling. That number on the left side of the chart, so if you go all the way over to the left and it says 27.5, yesterday pre-open that was 37.5. That's why I covered all but one short the day before that. So we do use the very immediate term of people buying panic puts, really, essentially, ahead of the CPI. We don't do that. Yesterday was a good day to be a little less short or even net neutral to net long. Now today you could flip it back because again, you're down to 27 and a half on that. So it's come way down, and that is what it is. Dealer gamma, if you don't know where that is, you're not playing at a high level, or certainly not at the highest. That we still have a negative dealer gamma setup. That means 5599. The S&P 500 close is below 5950, which is the number in the top left corner where grandma keeps the cookies. GVT, you got that? That's not it's not GTA. That's not Grand Theft Auto. That's GVT, which is grand theft of your hard-earned capital. If you didn't know that was going to happen, okay. So again, if you don't like that at this point and you're still on the call, I appreciate it. You are coachable. You don't have to like your coach, right? I'm not here to be liked. I prefer to be liked than hated, but that's fine. I'm not here to be liked. I'm here to help you get better. And the only way to do that is to be brutally honest in the moment. If you don't know anything about that, please read any books by Michael Jordan, LeBron James. You can go, Kobe Bryant. Some of them have the same coaches because that's how they are on them, and they want it because they need it. They need to get better. Yeah. Right. What else? Maybe we should start a podcast. What else? 1 month, 3 months. We already hit on that. Let's go to the rest of the world. Now, how could one wake up in the morning in this day and age and not understand that the rest of the world matters? Right. Now, I get that you want to be an enthusiast on Qs or Bitcoin. That's fine. But I'm enthusiastic about the process again. And that looks at the rest of the world. Now, we're short you'd be short, India, which has been a fantastic short. That was a long that we had for over a year. So again, another good example of going both ways. INDA is the ticker on that. So short some of that for the fam. And we're long Singapore, EWS. Japan's a short right now, and China looks like an interesting long that I haven't bought yet. Today, we're going to get a down day in Chinese stocks. So that'll be potentially the day that I add it to the family's long only account. Imagine that. What a call! I don't make calls. I execute on the process. And if the process by 9:30, actually, I usually wait till 9:50 because the first 20 minutes is kind of like amateur hour. We call it the kiddie pool of engagement where people, oh, stocks aren't down as much Bitcoin. Maybe I should buy. It's like whatever you're feeling or thinking, I don't care. I want to just capitalize on you. And probably starting at 9:50, if I see a buy signal in China, I may or may not buy it. So I don't have to have a call on it. I have to have a process for it. Big difference. Write it down. All right. We're net long Europe, Germany buy the damn dips, and it is dipping this morning. No dip for you in Polish stocks. Now, when you go to the golf course today after you listen to this for free, if you're retired and you got a pile that you want to risk manage, ask your friends if they're long Poland. Why wouldn't they be? I mean, because they understand the U.S. better. They understand the bag seven, what was the mag seven? Uh, okay. But I think people in Poland matter too, and I think the ticker is just fine. It's up 2% in the last month versus getting body bagged in plenty of U.S. equity exposures. We're long that. We're long EWD, which is Sweden. As I pointed out, we're long Germany, EWG. In commodities, oil's getting quad forward again after a one-day bounce. No surprise there. We're short of both XLE energy stocks at the sector level for the fam, and that's in the long short book. That's bigger than my long only book. Devon Energy, DVN, short that with impunity on the open. That's a very specific instruction. DVN, Dr. Victor Nancy. Okay, that's Fernando Vale, the Brazilian energy analyst that we have, who's been rails. Has been great on the short side of names like that. Already talked about gold. Is silver a buy? Of course it is, but only on down days. That's how we do it. We don't chase. I shall not chase. I shall not give up my kidney to Michael Saylor at 106,000 on Bitcoin before it goes down 25%. Oh no, I shall not. Now, if you want to do that, have at it. Just don't do it. Just don't tell your kids to do it. Silver. Now, this is an interesting one where a lot of people talk about the ratio. Well, it's kind of like an older way to think about it. It's not to say that the ratio at some point doesn't change or doesn't matter. It's just it's not what I start with. But the breakout for me would be something north of 35 on silver. That would easily put if you want to talk about silver, going up another 30% or 50% from here, it needs to get through that spot. Currently, we've been plenty fine just risk managing the range for silver, which the top end of the range is inside of that. So just know that. If you didn't know that, you can see it on your risk range sheet. You don't get that for free this morning, but I think they show it at the bottom of the non-teleprompter, as I can see the screen just ticking there. Narrowing risk range on 10-year bond yield. You got that. So again, the 10-year yield at 433. At 437, which is the top end of the range, what do? You buy bonds. Okay. Really simple. Top end of the range in bond yields. That means bonds are going down. You buy the bonds. Okay. You'll see Mucker buying the bonds for the fam today. All right. They're going to buy more bonds. Relatively new position, too, by the way, on the TLT, which is nice. Always nice to see something correcting so I can build it up, build up the position. That's what, because I like to buy things on sale. I know it's a little odd, but most Americans like to buy things on sale other than stocks. Yeah. What else you got going on out there this morning? Currencies, we're long the yen. FXY, we're long the British pound. We're short the dollar. There's a lot going on out there. And did I mention I'm short the Maestro? Let's take some questions.
All right, thank you, Coach. To talk about going over strategy, you just mentioned over 35 tickers within 20 minutes right there.
You counted them?
Yeah, the first time I ever counted. I was interested.
That's more than a ticker a minute.
That's pretty good. So I got kind of a big question here. Not big question, but basically, well, since we have a bunch of new subscribers, I did want to mention why we care so much about drawdowns. I think a big reason why is if you just avoid one drawdown, you could actually double your retirement account. And just for everybody who knows, we were calling for a risk-off situation on February 5th, where we first started warning about Quad 4. And you started changing your positions on February 6th, where you started shorting. You took out your long dollar position. You got out of Bitcoin on February 11th after being long since 10/22. And then you started getting out of almost
10/22 in the morning. You mean October?
October,
10/22.
2024.
Yeah, because some people say we're day traders. Yeah, I trade during the day, but no, we're full cycle investors. We bought Bitcoin in October because Quad 4 ended in September, the most recent Quad 4 prior to the one that started in February.
And you got rid of most of your higher beta positions on around February 11th to at the end was about February 25th, February 28th. And since then, the S&P 500 has been down 5.4%, and the high retail sentiment basket's been down 12%. So we got a lot of people out way before the move. And so my question with all that is, okay, we were right on getting people out. And so my question is, what components are you looking at today, or in terms of the whole process, that's telling you if this is a bear market bounce or an extended rally from the S&P 500 from here?
Well, that I don't. Well, because you edit it. But the early look is 100% focused on answering that question and answering it mathematically, right? Again, we have a rules-based, math-based, rules-based decision-making process. We don't wake up with the feels. It feels like this, or the looks. It looks like it's another good one from the old wall. Or JP Morgan this morning saying, well, the worst should be behind us after not telling you that the worst was coming. Isn't that always great? Hey, your ship is no longer safe in port now that you're out there and your family's going to capsize. But it's the worst is over. Well, thanks. No, 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 no. There are three things you look for just for starts. And again, you have to look at everything, not just the S&P 500, but let's use the S&P 500 as an example. Okay, S&P 500. If it were to signal a series of higher lows in the risk range as opposed to lower lows, which it has signaled for the last 7 days, then that would be the first thing. The second thing would be an immediate term trade breakout. That's why I built the process that way, multi-duration. So you got super immediate term, which is the risk range, and then you have 3 weeks or less, which is the immediate term trade signal level to go bullish. And that generally front runs those two things, a series of higher lows and a breakout on the trade signal that it could portend to a breakout on a trend basis, which is 3 months or more, which would typically typify that you're heading into a quad that is not Quad 4. So those three things. I mean, it's not, if you do this for a quarter century like I have, and you can boil it down like that, guess what? A hard game gets a little bit easier, right? Because there's no variability in what I need to think or do. There is just discipline. There's a lot of silence. There's stillness. The opposite of what you see on Reddit, CNBC, etc. the opposite. That's why the process works opposite to how other people are bag holding when they're losing a lot of money.
Uh, Great answer. And I think another big thing that I'm actually seeing is on the short dated vol curve from Tier 1 Alpha, right? They're
Yep.
already buying, well, the short dated vol curve is at 29.06 for the next Fed presser. It's already starting there, right? And that's on Wednesday of next week. And so maybe can you just, I'm sure most people who are watching this do not know what the short dated vol curve even is, even though you mentioned it. Can you maybe describe what typically happens with the market around these events and how they start buying puts and what that has to do for dealers?
Well, first of all, this is definitely part. Like we've had institutional clients ping me on this. They're like, "Well, Keith, I hear you because we're the first firm to go from take out all the rate cuts." Because again, we were
Yeah.
bullish. Show the guys, show the since we published it today. I mean, show the nowcast. One of the most valuable things that institutional clients pay us for is the CPI nowcast.
Oh yeah.
So if you guys can show our monthly, that would be great. The one that shows the most recent downtick for our March CPI number, which goes all the way down to 2.47%. Do you guys have that chart up?
We do
There we
now.
go. Okay. Okay. So follow me on this chart. And Rooster, if you want to get up and doodle on it, you haven't done that before. I got no problem with you doodling on the chart. You want to do that? Do little doodles?
Um, you
No?
keep talking. I don't think the thing's in position to do that.
Okay. So let's say, okay, so go to the left side of the chart. See where so see where it's all pink over there? See how the rate of change of CPI this was what we called quad four, when inflation, the rate of change of inflation is going down. You don't have to be a calculus major to understand this. It's called rate of change though, and it's just look at the direction. It's like going down a hill on your bike or in a car or whatever. Okay, so it goes all the way down to September at 2.44. See where the weather's about to change there from pink to green, you know? So that's not like a sunset. That's going from disinflation to reflation. So our model nailed that. That's where we went from long treasuries, long, all the stuff that, we're back to long again, because now you can see after inflation go from 2.44 all the way up to 3.00, which we nailed. We said it was going to tick down for the first month in the most recent months, which is February reported in March. And now our nowcast is for it to tick down materially again to 2.47. So from 3.0 to 2.47. I mean, if all you do is get that right, if that's all you do is get right, you're going to get so many things right. You're going to get bond yields right. You're going to get the dollar right. You're going to get everything growth right. These are up and down. And that's the most important thing. So we're not going to show this to you for free every day. We update it daily, weekly, monthly. Again, I would submit that if the trillions in assets under management are paying, in some cases, 6 to 7 digits a year for discussions and distributions of these points of content, then it's probably interesting for those of you that are seeing this for the first time for free. But that's where we're at. I mean, that's why I'm set up the way that I have been, and why it's been a profitable venture.
Yeah, I think just to expand on that, right, when we know where inflation is going accurately, you know that what the people on CNBC are going to do, which is beg for more rate cuts, which then push, right, and try to push their yields down lower, which is why bond positions would go up on that, because they're going to keep trying to push.
And to finish on that point, just on your question originally, because I didn't finish on it, the finishing move really is the Fed meeting next week. Now, what we've been saying, like, go back to the chart one more time. Okay, let's do it one more time. There's nothing better than repetition. Nothing, if you want to learn something, okay, with live examples. So again, look at the inflation chart. When it was in pink and the thing was going down, Wall Street was looking for anywhere between 5 and 10 interest rate cuts. They had a panic rate cut by the Fed by 50 basis points in February, which was like a joke, because they panicked right before the thing was going to turn uphill. Right? Then we said they're going to take out all the rate cuts. Now we're saying, and 6 weeks ago, I said they're going to start adding back rate cuts. And we're the first firm to say that the Fed was going to actually start cutting 2 to 3 times. Now, probably 3 to 4. Now, so what's going to happen next week with the Fed meeting is that Powell's probably not going to say that because Powell doesn't have an accurate inflation nowcast unless he uses ours. Scott Bessent does. That's why he sounds much more logical and in line with us because he's a market practitioner. He's a former Hedgeye subscriber. These, and he's. I'm not going to confirm or deny that he sees our nowcasts every single day. So there's a lot to think about there. But the bond market's going to wrestle with that because now they're all kind of whipped around here, and the move index is at 104.
Absolutely. Do you have anything else that you'd like to hit on?
Well, I go back. I mean, one thing I want to go back to, because again, when it's free, we typically do have, what I don't affectionately call retail investors. Now, I don't want you to be a retail investor. Goldman Sachs must have made up retail investor because that means you're a dum-dum and we're going to front run you. We're going to sell you IPOs. We're going to ram, Eric Trump rammed crypto down people's throats on a Sunday saying that was good for the retail investor. Being a retail investor means you're generally macro unaware. You're an enthusiast about something and you're bag holding. That's not what we want you to be. Just because you're an individual doesn't mean you're retail. You're not like a Walmart shopper. You go for premium. You like nice cars. You have money. You want to be a self-aware, macro-aware, self-directed investor. You don't want to be the person that's bag holding when a bunch of other dopes are holding the same things. So when Rooster said, and I don't know if you can show the chart of what he said, the high retail sentiment basket. Goldman publishes this every day, and they let their institutional accounts trade it. So dum-dums chasing and Goldman's institutional, the ones that know how to do it, at least the ones we advise, you fade it. They do the opposite. Yeah.
Sorry.
Yeah.
No, keep going. I'm pulling it up.
Okay. So the high retail sentiment basket yesterday, after going down 30% since January, bounced 2.3%. So that's what we call IPOs, by the way, just to revisit the IPOs that get jammed down your throat and pumped on CNBC. Those popped too. And so did profitless tech. These are like what we call factor exposures or baskets that hedge funds trade against the crowd and against the retail dumb investor, right? Again, it's not a thing. So again, if you all own the same stocks, let me guess, you're long Palantir, NVIDIA, little Solana with some XRP sprinkled on top of it. You have the same, you're long, some people are long TSLL. I mean, that's the 2 times Tesla. It was down 84% since January as of yesterday and then bounced 15.6%. Well, that's why some people like it, right, Rooster? Retail investors like to gamble. They think that there's a quick fix. They think they can get rich doing this because post-pandemic they did, or at least less poor. And the fact of the matter is that these things were to be faded yesterday. When the bounces are led by the stuff that's crashing, that's typically what happens in bear markets, is that the bounces are bigger than the updates.
No, absolutely. And I just sent it to Genron. The retail investor in that basket since June of 2021, they haven't broken even yet, right? So from June of 2021, they went down 72%. They finally, right close to this current cycle peak, they got pretty close to breaking even, less than 1% left, and then they've been down 29.8% since. So that's why it's a lot.
But Rooster, but nobody could have predicted the 2022 crash. Nobody, right? If that didn't happen, that wouldn't happen, right? Nobody, other than Hedgeye.
Other than us. And we got people out much before that.
Yeah, I mean, I was up 8% in 2022. I mean, that's the whole thing. Like, do it with your own money, right? Like, not the bullshit on CNBC where there's no timestamps. There's but you show me, actually, at least Joey Terranova has Joey T, which I'm short, where he shows it, or Telecom Tom Lee has the granny shot thing, GRNY, which we're also short. At least they had the confidence to put their name on it. That doesn't mean that it ends well, but really, like, if you do this with your own money, and you have $100,000, let's say you work your ass off, your retirement account is $100,000, maybe it's $1 million. Are you willing to just okay, you had a great ride, which we did too, from October to January. Are you willing to wake up tomorrow morning to $80,000 or 800? No. It's not a thing you would want to do, right? Now, the only people that do that are the ones who are purporting to be long Bitcoin at 10 cents. I mean, none of these people are long Bitcoin at 10 cents. Most of these people bought it at 100,000 because everyone was pumping it. The pumpers from Sailor on out telling you to buy it with your kidneys were saying it's going to 200,000, 500,000. Like that. That's the problem, right? Is the pumping right before the quad fours. That's our main problem. It's not trying to dunk on people. It's trying to say, okay, look, we want your 100,000 to be 102,000. And when it corrects, it goes to 99,000. And in a bull market, it goes to 130,000. And then when we go into a quad four, it goes to 125,000. And then we go back up again. That is a far better way. There's nobody who can tell me differently. And again, it's importantly is very importantly for people who have money. They'll understand it better. If you're just trying to make money because you have none and you live in a trailer down by the river, then I don't doubt that you bought Solana. We bought it too. I
Yeah.
used to be long 6 different cryptocurrencies in January, including the Dogecoin.
Well, yeah, and for those people trying to make money, what we really provide, which is what a lot of institutional people love, is we really help people get risk on and risk off. And knowing when to be risk on versus risk off can really help you preserve and protect your money and outperform the market. Along with
Amen, Rooster. Amen. I got to go trade the open.
All right,
So
we're gonna wrap it up there. We do this every single day. We have a ton of products where you can see everything. If you like written versions of what we just did, we have the early look. This is which also helps basically a lot of what we already said. We have this show, the macro show, and then we have higher tier subscriptions. Just ask, email in. We do this every single day, and we don't stop. So why not join us? Anyway, we'll be back tomorrow at 9 a.m. Good luck out there.